desk, almost everyone has this book. Yes, everyone has read this book. It's really throughout the world. It is the reference work, I would say. So let's start with the definition. What is a derivative? What are we really looking for? What are we looking at? Well, it's an instrument, and the value of this derivative actually depends on another asset, another value of another asset, or another underlying source of risk. We will be talking about, we will start with the forwards. We will also discuss the futures because they're very similar. We will also have a look at options and swaps if we have time. But of course you can go a lot further looking at exotics as well. And so typically here the underlying will be stocks, it can be currency, interest rates, but the underlying of a future can also be the weather, it could also be corn, it can actually be anything that has a source of, that is a source of risk. Did you already study forward and futures and options? Yes or no? Yes, you already studied them.
For official class about derivative, we actually have not advanced knowledge, just very basic.
Okay, okay. So what my intention was today was to do the pricing of the futures and the forwards, and we'll see where we get. And if we have some time, we can also, if you already know the options, then we will have a look at the swaps. Okay, did you already discuss swaps? Also, yes.
Yeah, I think you can mention that again for everyone.
Yes? And did you do interest rate swaps or commodity swaps?
No.
You didn't do them?
Yeah.
Okay, all right. Okay. So, why are derivatives so important? Well, because we want to use them as a tool to manage risk. And so here, as a tool to manage risk, you can go a lot further by also using credit derivatives to use them on credit, to use asset-backed securities, to use hybrids, and also in bonds, very often you have derivatives attached to the bond to make them convertible, to make them reverse convertible, to make them to give them an extra characteristic, you could say. So, what do we do? Well, we look at we want to determine the price, and the price actually reflects the cost of passing on the risk. And what you also see is that if you have assets on which there are derivatives trading on, then you see that it's also good for the underlying market. You see that the underlying market becomes more liquid because you actually have more information about the asset. So it really, they tend to be more liquid than the market of the underlying. And very often it's also easier. If you want to go short selling, it's easier to go short selling in the derivatives market than to go short selling in the underlying market. And so, it is a very nice tool to use as protection against risk. And you can do this at a lower cost than you would if you were just trading in the underlying market. So there are a lot of positive sides to the derivatives. And if we look at the different benefits, other benefits that are included in the use of derivatives, then one of the things to mention is that they're a very important source of information. They provide you with extra information And definitely, if you want to hedge, if you want to protect yourself against the volatility, against changing of the price of the underlying, then the use of derivatives is actually very important. And this can go in two ways. If you look at forwards and the futures and the swaps, there it is definitely interesting because you lock in the price, you fix the price, you set the price. However, with options, what you really or options, what makes options so interesting is the fact that the underlying is very volatile and that you can lock in the price but still keep an upward potential. Yes. So whereas forward futures and swaps are symmetric products, the options are asymmetric products because you have a floor. You could say that for with some options you can reduce your losses and still look at the upside and still have the upside potential. So they also make the market of the underlying more efficient in the sense that you have more trading, you have more information, and that is what makes it actually more interesting. However, derivatives have been criticized a lot, when used in the wrong way, they can lead to several problems. So what are they meant for? Well, they're meant to hedge, but if you don't use them to hedge, Warren Buffett's very famous expression that it is the weapons of mass destruction. They gave him a very bad reputation to derivatives, but used in the right way, they actually do what they promise to, and they actually can help you to get some protection against risk. However, they shouldn't be used to gamble. And of course, what you need to do with them is to manage unwanted risk. You want to try to get rid of risk, and that's what they should be used for. However, anyone who wants to hedge needs to have a counterparty. If you want to, although it's not really correct what I'm saying, but if you want to buy a derivative, there has to be someone who takes the opposite side, who is willing to sell. So in that way, speculators may be necessary to take the position, the opposite position of the position you want to take. Because otherwise you may not be, your agreement may not be set up. So although I'm not really in favor of speculation as such, speculators as such, well, we should also be aware of the fact that if only hedgers were in the market, maybe we wouldn't find a counterparty. So as such, it may not be such a bad thing that there are hedgers, that there are speculators, because they are also necessary for the hedgers to be the counterparty. So speculation really is necessary because the hedgers need someone to take the risk. They need to have a counterparty as well. Derivatives are, on the one hand, they can be traded on the exchange, and this Chicago Board of Options Exchange at CME is very important. However, not all options are traded on the exchange, and the over-the-counter market in derivatives is actually very important. The big difference, of course, is that assets or derivatives that are traded on the exchange are standardized. And you have different characteristics, but they are standardized with respect to the maturity, with respect to the underlying, with respect to all sorts of characteristics. So if you don't really fit into these specifications, then and you want to have a contract with your counterparty, then you typically move to the OTC market. And there you just have, say, treasurers. The treasurer of a company just calls its bank and say, okay, I want to have the derivative specifically with these characteristics. And then really have a one-to-one contract. And so this is the over-the-counter market. Okay. Whenever you have a derivatives contract between two counterparties where it is really made for the client, that is the OTC product, whereas the standardized product is traded on the exchange. So they actually have these two possibilities. And it can be the case in forwards, in options, in swaps. But so what you already see here is that a forward is not traded on the exchange. A forward is a product that you will find in the over-the-counter market. So how are these derivatives used now in reality? Because we want them to work to cover risk. We want them to work as a hedge, but there are many different uses for them as well. So you can hedge in the way that you can transfer the risk, but it's also possible to speculate, to when you think the market is going down to use them, when you think the market is going up to use them. Well, you might say, well, why don't we just use the underlying? Why would you use an option instead of a stock, for instance? If you think the stock is going down, why would you use options? Why would you use the underlying? Well, if you use the underlying, typically the cost is a lot higher. With derivative, the initial cost is lower, but the premium is lost. Whereas with the stock, you can still sell it. With the derivatives, the premium is lost. So you have, you could say, you have higher leverage power, you could say, with the options, but you run also in a lot more risk. So speculation is definitely possible here. You can try to lock in an arbitrage profit, changing the nature of a liability. And changing the nature of a liability is typically what you do with a swap. For instance, you have a loan and it has a fixed rate. So you are paying fixed interest rate and you want to change it into a floating rate. Why would you want to do that? If you think that the rates are going down, you might not be interested in a fixed rate, and you want to change your fixed rate into a floating rate. Or the opposite, I have a floating rate, I think the rates are going up, I want to change it into a fixed rate. That's what a swap can help you with. So you change the nature of your liability from a floating rate to a fixed rate, or vice versa. Or to change the nature of an investment without really having to sell the portfolio and buy another one. Yes, you could do that with options. You could also do that with futures. We will see at the very end how we can actually solve, how we could actually do that. So which derivatives are we going to discuss? So at first I wanted to do the forwards, the futures, and the options, but I think you know a little bit more about the options and a bit less about the swaps, so it's probably best that I talk about the swaps and not so much about the option. Is that correct? But you tell me. For me, it's all the same. Normally, I teach 30 hours about options. So whether during 3 hours I discuss one product or the other, for me it doesn't matter. Yes. So tell me what you prefer. Tell me where you know less. What do you know most about the options or most about the swaps?
Option.
Sorry?
I think more about option.
You know more about options, and then we'll talk about the swaps. Okay? All right. So what I wanted to do is to introduce forward contracts, but let me say in an alternative way. Okay. I really like reading, and I'm a big fan of Lisa Gardner. I used to be a big fan of Lee Child, and now I'm a big fan of Lisa Gardner, and it's like a novels about murder. Someone disappears and you're trying to figure out what went wrong. And suppose that before coming here, I went to the store and I really wanted to buy the latest novel of Lisa Gardner. And well, I put it in. But suppose that you wanted to go and buy this book, suppose. And if the book is in stock, suppose you pay like $200 to buy the book. If you do this, you pay and you get the book. So this is what we call a cash transaction. It's a spot market. So you pay and you get delivery immediately, a spot transaction, and so the deal is closed. Okay. That's the spot market. Okay. However, if the book is sold out, or if the book was sold out, and you asked for a back order, and they told you, yes, you can have, well, I didn't say 7 days, I should have mentioned it, it's available in about a month, say, okay, because you had to wait, then you would have to wait and pay your copy when it is released, when you find it, and so you could say the transaction doesn't take place immediately, but it takes place after several days, and you promise to pay the price of the book, and when it arrives, you will pay for it. So in that sense, in this example, the transaction is for the delivery of an asset. In our case, the asset is a book. Suppose that the time to maturity is 7 days, and the agreed upon price is $220,000. Yes. So on the 15th of March, you agreed to buy the book at a price of $220,000 and receive the book when it arrives. That's what you agree doing. And the bookstore agrees to accept the payment and to give you the book. So you set up the agreement on the 15th of March. And for instance, and here I took not 7 days later, but I took a month later, and suppose that after a month it arrives, at that time, at maturity, you pay for it, you pay the price that you agreed upon at initiation of the contract, and so indeed, the bookstore then gives you the book and receives the payment. And so in that situation, you would be the long position because you're the one on the buying side, and the bookstore is the short position because it's the one on the selling side. So here you already see that when you're on the buying side, we call it we go long, and when we're on the selling side, we actually go short. So when you look at a forward contract, you see that it is, and if you look at it in the market, it is very similar to this forward contract that I set up with the bookstore. However, the underlying is going to be something that has a bit greater value, and the underlying is the asset is too large to ignore the time value of money, because here I used a month and I didn't ask for anything different. So the interest should actually also be reflected in the delivery price. But what is very important here is that when you step into a forward, you have an obligation. You promise to pay the price and buy a certain asset, you have to do it. You cannot get out of it. So in the forward contract, you see it's binding obligation to buy or sell, and the price is set today, and you will buy or sell in the future at a certain point of time that is agreed upon now. And you will have specifications about how much has to be delivered, at what time, where, so the date, the place, and of course the buyer will have to pay at the time of delivery. So you could say you have a handshake today, and the deal is made today, but the payment will be made at a later date. The exchange of goods will also occur at a later date. So here, neither party can legally get out of the commitment, but what can happen is that you can offset your contract by another contract. So suppose that, and I go back to my book example, suppose that I read the reviews of the book and I think, that's not really what I was looking for. Then I may be able to pass it on to someone else. For instance, my neighbor, who is a big fan and who forgot to order the book, and so there I can offer the book to my neighbor, and so that means that I actually step into a contract with my neighbor to cancel out my contract. Okay. Because I still have my contract, I will, if it was a real forward, I would have to get the asset and pay for it, but I can pass it on to someone else by again stepping into another forward with someone else, but in the opposite direction. Yes. Whereas in the first one, I was long. In the second one, I am short. So a long contract and a short, so a long position and a short position cancel each other out. Okay. And that way I can get out of my, well, I will have to buy the book, but I can get rid of it in this way, and I can even negotiate a better price. The first thing we want to know when we step into a forward contract is, of course, what are the gains and when do I have a gain and when do I have a loss? And so what we really look at is the situation at payoff time, at expiration. What happens at expiration? What is the value at expiration? And so we look at what happens at the end of the lifetime of the contract and what the position then is. So on the one hand, it depends on the position that we take. Are we in the long position or are we in the short position? So if I am in the long position, then I take my spot at expiration minus the price that we agreed upon initially, minus the forward price, okay, so the delivery price. And if we are in the short position, it's actually the opposite, it's K minus ST. What does this really represent? What does that give us? Well, it means that if the price, so if I am long, if I'm on the buying side, and at the end of the maturity, the price of the underlying has increased, then with my forwards, I have to buy at the agreed upon price K, which is actually lower than the current price and the price at maturity, so it means that my payoff will be positive. If, however, the price has declined, then, well, I cannot buy at the market at the lower price. No, because I have this obligation. As I am in this forward contract and I am obliged to buy at price K. If that is the case, well, I'm losing money. And so the payoff diagram represents how much I am winning or how much I am losing at maturity. And the thing here is that it is an obligation. I'm obliged to buy. I have to buy at the promised price K. That is what is agreed upon in the contract. If you are in the short position, you actually are obliged to sell. You have to sell at price K. So here it's actually, you could say, the opposite situation. Because if the price drops, well, if the price here, if the price drops, then you see that in the market, I would have to sell at a lower price, but with my forward contract, I can still sell at K. So I will be happy when the price drops because I'm making an excess. My payoff will be positive. If the price increases and I want to sell, well, then I'm not so happy because I agreed to sell at price K. And even though in the market I could have sold at a higher price, I am now in a contract where I'm obliged to sell at K. So you see that whenever the long is winning, the short is losing. So they are the exact mirroring of each other. They are the counterparty of each other. So yes. So I want to look at an example. And the example is already, it's already on a more complicated product, I would say. But I just want to look at the different aspects. So suppose that I have an index, and John Hall makes a bit fun of the S&P 500, and he created his own index, and he calls it the Special Enrich 500. And what I do when I want to have information about derivatives, I always want to write down what is the current spot price. And so for the current spot price, I use S0. So my underline will always be represented by S. And so I'm interested in what is S0. This is my spot price. Now, for a forward, I'm interested in what is K. And K will be, it will be my delivery price. So, and I'm also interested in what is the maturity. In our case, it is 1020. We're also interested in at maturity, so we're at the end of the contract, our spot price here appears to be 1050. So you could say in a forward, can you actually read this? Or should I try another? And it's still a whiteboard, I hope, yes. So I'm always interested in, and so this is, so here, this is actually 6 months. Here is where the contract is set up. And this is actually my maturity. This is the expiration. This is where the transaction occurs. So we initiate the contract here, and so I want to have information at time 0, but I also need information, or I'll have to wait until the end to see whether my payoff will be positive or negative. Okay? So here, the long position, the payoff, what will it be? Well, it will be ST minus K. So here at maturity, if I am in a long position, then my payoff will be 30. If I am in a short position,
you will lose 30.
I will lose 30. Yeah, so when I'm in the long position, it's always the opposite payoff from the short position. Yes. So if I'm winning in the long, so in the long position, and I should have taken my other computer, but so if we go the payoff and ST, so we say K here is 1020. This is my K, yes. And if we're long, it means that, remember, my long forward looks like this. The price has gone up to 1050. So it means that I will have a gain of 30. This is my long position. If I'm in the short position, again, I want to look at my payoff and I want to know what is the underlying at maturity. Well, the initial situation is the same, so K was 1020. Shouldn't forget the dollar sign. However, I was in the short forward and the price went up. The price went up, so ST here is 1050. In that case, I'm actually losing money. Because remember, in the long forward, my payoff is ST minus K. This is the formula by which I have to calculate the payoff. And so ST minus K is 1050 minus 1020. Whereas over here, I'm in the short forward. Here it is actually K minus ST. So here I have 1020 minus 1050. So here I'm losing $30. Okay. So finding the payoff is relatively simple. Yes. ST minus K, K minus ST. Very simple. Okay. And, well, I also drew here. What you also see is that if you are both in a long position and in a short position, what do you have then? So suppose that I am long in this index, but I want to get out of the market. Then what I will do is I will take the opposite position. So if I am long, if I am in this position, and I want to get out of the market, I take a short, and that's what I did, and I add this, I add both contracts. If I add both contracts, then the sum is 0. So if you want to get out of the forward or of the forward market in this situation and you are long, you just take the opposite position. Okay? Because then you could say, I become my own counterparty. Yes, I am both buying and selling, so I'm out of the market. So typically that's what you do if you want to get out of the market. We say you counter-turn your position, so you take the opposite position to get out of the market. That's one thing that especially is done in the futures market, but we'll talk about that later. So suppose that we have an American company and it knows that it will have to pay 3 million in euro in 3 months. The current exchange rate is $1.09 per euro. How can I use a forward to hedge the position? So we have an American firm, and we will have to pay in euro. Okay. So what does it mean? What will I have? I only have American dollars, but I have to pay in euro in 3 months. What can I do? I know now that I have to pay in 3 million euro in 3 months. What can I do? I can do a spot transaction. What does that mean? Yes, so what I can do is I can buy in the spot, so it means buy the euros now, and then I hold on to them for 3 months and then I pay. That's a spot transaction. But I can also do a forward transaction. How would I do it then? What would I do? You go long in a forward. Indeed, why long? Because you're on the buying side, you're going to buy euros, and you want to fix the price, you want to fix the exchange rate. So indeed, with a long forward, we would be able to hedge our exposure in the sense that we would be able to lock in the exchange rate. But what is the disadvantage, you could say, is that when we step into a forward, we have an obligation. So it means if we have an obligation, if the exchange rate would change in our favor, we would not be able to benefit from it. But if the exchange rate would get worse, then we have the forward and we have fixed our rate. Yeah. So what a forward does is to make sure you fix the price. So that is very helpful. So you know what you're up against. You know what the costs will be. So in that sense, it is a very nice product to actually use. What is very typical about the forward contract is that it's an over-the-counter product. Yes, it is not traded on the exchange. So it's not standardized. You can really specify the expiration date yourself. It is typically settled at the end of the contract. So it means that settlement typically will take place. And well, one of the downsides, one of the negative points is that there can be credit risk. Where can there be credit risk, you think? Where is the risk? When do you have a risk? If you look again at the long position, is there any risk here? Here and on this side of the graph, where st minus k is negative. When st minus k is negative, you have to pay. Yes. Do you have credit risk when you have to pay? There is credit risk with respect to you, yes? But the credit risk that we're talking about here is that the risk is what I bear, that my counterparty cannot pay me. Yes. So, where I'm not receiving any money, I don't have credit risk with respect to the product, yes? Because I'm not expecting to receive anything. But when the product the payoff is positive, the credit risk that you bear is the fact that, well, maybe my counterparty cannot pay. If my counterparty cannot pay, then this will not be my payoff. Okay. So the credit risk that you bear in this product is the fact that when your product has a positive payoff, and for some reason, for one reason or another, your counterparty is not able to pay, then that is credit risk that you have in a forward contract. Because it's actually a contract where you make the deal here, and where you don't really look at it until maturity. And it's at maturity that you're going to say, okay, now you have to pay me so much, or now I have to pay so much. Okay? But during the lifetime of the contract, you don't really look at it. And so at the end, it is possible that your counterparty, if he has to pay you, that he's not able to deliver you. So when you're having positive payoff, that is where you have the risk that your counterparty cannot deliver. So on the one hand, you can say that a forward contract is subject to a degree of uncertainty. What uncertainty can you think of? Well, if we go back to the example of the bookstore, of the book, then suppose that you step into a forward contract, and in the forward contract you said that you would buy the book at $220,000. Okay? Suppose that you go to another shop and you see the same book, but a lot cheaper. Yes. Well, you still have the contract, so you cannot benefit from it. But for the bookstore, the same. If it becomes very popular and the price would go up, well, for a book it's not that common. But for any other product, it is quite possible that the price goes up. Well, what if the bookstore would not want to sell at this price? Yes. For forward contracts in reality, because this is just a very simple example, the risk is a lot bigger. So that's why, although you still have a lot of forward contracts, people have created standardized forward contracts, and these are, of course, futures. And definitely to reduce the risk of default of your counterparty, so to reduce the credit risk that you see in a forward contract, future markets have evolved. And so you could say that futures are actually exchange-traded forwards. Yes. But because they're traded on the exchange, there's a lot of standardization that has taken place And so that makes it, on the one hand, interesting. On the other hand, yes, you are stuck with certain characteristics that you can no longer change. So, in principle, they're the same as forwards, but there are some pricing differences, some institutional differences. And so you see that there is really standardization that takes place with respect to delivery agreements and etc. The quality that is required, especially if you have assets, if you have commodities as underlying, and what is important is the daily settlement and the margins. You know how to work with the margins? The marking to margins, have you seen that? Yes, okay. So that makes it the fact that for a future, when you step into a future, you actually need to have an account at your broker and your daily gains will be booked on it. But if you bear losses, the losses will be taken out of your account on a daily basis, and if the money on your account drops below a certain level, you will have to deposit extra. That way, there is no counterparty risk anymore. Because on a daily basis, you get your benefits. On a daily basis, if you have to pay, well, you're paying up on your account, actually, on a daily basis as well. So you have to deposit money into an account, and every day, if you make gains, they will be put on that account. If you bear losses, it will be taken from that account. Of course, if you make a lot of gains, you will be able to withdraw some of the money from the margin account, but you will have to leave a certain amount to make sure that if you bear losses in the future, that they can take it out of your account. But that way, the counterparty risk really reduces, because it's every day that you have to pay up if you're making losses. So this makes it very interesting as a product, because whereas with the forwards, we set up the contract and we finalize it over here at the end, with the future, it's every day. Okay. So it's a lot, in that sense, the counterparty risk has almost disappeared, I would say. So there are several exchange trading futures that are there, and the most important ones are the CME Group is the biggest one. At Euronext, it's especially Amsterdam and Paris that have a very good value liquid market, and Tokyo Financial Exchange is known as well. If you look at the total volume of derivatives trading, that a lot of people think that it is, that it grows very rapidly, and it's true. But it's especially been true for the Asia Pacific, and especially 2023, options trading in India has really increased enormously, where you also see that private investors, you could say, are also stepping into the derivatives market, and you see that although we always think that it's North America that is driving the increase, it's really the Asia Pacific and India, more specifically, that is really driving this expansion into derivatives trading, which makes it even more important to really look at the market, and it is booming so rapidly. I just put a few examples of future contracts as well. For instance, you can buy 100 ounces of gold at $2,300 per ounce in December. We can sell C2 sterling at $1.3 per pound in March. You can sell 1 barrel of crude oil in April. So there are several underlyings. There are not just financial assets, not just commodities. A lot of things can really be used as an underlying in the future markets. So as commodities, oil is very important, but also wheat, corn, even pork bellies. A lot of products are actually traded on the futures market. However, not everything. Yes, if you would want to find a future on kerosene, this is not possible. The fuel of planes, you don't find that. So, although you already find a lot of futures on a lot of underlyings, not everything is out there. So what do you think you have to do? If you want to hedge a product, you want to use a future, but on the underlying you want to hedge, you don't find a future. What will you do? So suppose I want to find a future on kerosene, so on the fuel of planes, yes? But I don't find it. It's not out there. Suppose that it's not out there. What would you do? You would try to find a future on an underlying that is very similar to the underlying that you have to kerosene. So you could check whether the relationship, the correlation between kerosene, the price of, between kerosene and, say, Brent crude oil. So whether you could use a future on Brent crude oil to actually hedge your situation on kerosene. Okay. So this is what we call a cross hedge. So when the underlying that you want to hedge is when there is no future on it available, and you want to have a liquid product, you want to have a future, you don't want to step into a forward, it is possible, then you are looking for a future on an asset that looks very similar. It has very similar characteristics, especially pricing characteristics to that product that you want to hedge. Okay. Of course, then, do you think the risk will be smaller than when you hedge the exact product, or will it be larger? Yes, it will be. There will be a bit more risk involved. Yes, because the underlying product is not exactly the same as the product you want to hedge. So the pricing differences will also the changes in the prices between, say, the Brent oil and the kerosene will also lead to extra risk. Yeah. So it will be better if you find a future on the product you want to hedge. It's better to take that future. But if it doesn't exist, then you try to look for a future on a product that is as similar as possible to the product that you want to hedge. So you have a lot of examples of futures here, and you could ask yourself, well, I told you that futures are being used to hedge, to speculate, but also to create to exploit an arbitrage. Well, one question you could ask yourself, well, suppose that the spot price of gold, and so the spot price of gold, meaning the price today, is $2,300, and this should be per ounce. The 1 year forward price of gold is $2,400 per ounce. And if we know that the 1 year risk-free rate is 5% per year with annual compounding, And the question may be, well, is there an arbitrage? And so this kind of question, and to determine the price of forwards and futures, that is something that I would like to do after the break. Okay, so I'll give you a short break, and after the break we will look at the pricing of forwards and futures, and I will treat them as rather similar, although there are some differences with respect to the margin and to the fact that with a forward you don't look at the product until maturity, and you don't have this daily marking to market of your account. But we will look at some principles on how to price these products. Okay? All right. Then you can have a 5-minute break, and we'll go into the details of this.
Nguyên ông được lên là truyền hình được hơn.
Trời ông
Mình được đặt ngành thôi chứ.
ấy đã giờ gì đó
Bây giờ học phái sinh đây của nó đây
thì có là cái Google Ads nào
chưa
làm đó cái điểm danh có đăng ký trước này
Mình sẽ chịu sớm.
không ý đâu
Ghép không dễ vậy.
cái đề
Làm hai là mình thi hay làm gì?
cái này là phải môn nghiệp vụ
Ghép đi nghe.
ngày vô ngày một bữa quay nãy giờ quay làm môn tổng nghiệp vụ đâu mày cảm giác mày sẽ bị chạy cái hàng đó
Quyền.
Rio
đấy là đăng ký giả
Đang nghĩ đó.
You guys don't need a break, I think. Are you all working?
ủa sao lại không phải hỏi gì vậy
đây bon bên đâu mổ không?
nói chung là
Cái điện thoại vô cửa sổ.
nó tức được bé
Trong cái chi phí mình không hợp lý. Cái quyền đó không hợp lý.
Bon bên đâu mổ?
cái đăng ký với cái em mà tao nó có sẵn luôn tớ bị đẹp
Ở trên kia hả? Lại đi nào cái đó hả?
thì đó là có thể không
Lên đó là có hả?
nãy giờ không phải xin cái màu que là ngoài bữa đó là tôi đi bài kịch bản rồi là tôi đưa cho ông tính vẽ cái hình còn cái phần công cái là công 2 với công 3 còn công 1 là có coi nhưng mà có thấm nóng không à coi trong cái cuốn kia cuốn luôn để
Miếng xong ban hồng ra
cái link mình gửi á, cái link mà tổng hợp á, nó đâu có nói là phân biệt là loại tài sản nào nó sẽ dùng cho cái nào, nó chỉ nói là công thức với cái phần loại của tham hoặc là cái bản chất đó, đúng không?
nó có chỉ công thức á.
Không, ý là nó không có nói là tùy vào loại nào thì nên dùng cái nào.
Cái đó thì dựa theo cái của thầy gửi. Thầy gửi là cái này nature của nó là có cái bản chất của chỉ số là cái gì, với cái cách tỷ trọng, tính tỷ trọng của nó là trong đó hết á. Cái của ông tính tỷ trọng là sao? Chỉ số của ông tính tỷ trọng.
Thế mà cái sai trên hay là cái bài tập cái đề
Đâu đâu cái hình cái đề thì gửi đâu cái đề mà thì
thầy chỉ
trăm
nói
bảy
là ấy là nhớ cái đề thôi. Còn mình á là theo tôi nghĩ ý thầy á là thầy muốn mình giải thích tại sao chọn cái này mà chọn cái này thì dễ, cái này thì dựa vào chỉ số tôi thấy được đó là nó có cái thông tin để mà cái đó là nói về lợi nhuận không hay là nói về giá không hay là nói về cả hai thì nó là cái này cái đánh return rồi. Còn cái này á thì tôi là market cách quay.
Thì ông chỉ cần đi cái cách tính thì cách quay thì sao thôi.
Nhưng mà mình còn phải bình luận là bản thân mình chọn
Không, thầy chỉ cần mình hiểu mình đang làm gì thôi với thầy đâu.
dạ, nó nhiều thì đơn giản rồi.
Ý thầy là cái tỷ số đó là nó tính sao thôi.
Cái đó thì đơn giản rồi. Thì nó còn là như thế nào?
Cái của ông là price index thôi.
Của tôi là make return. Mình là Derivaties đúng không?
Ừ.
Mà tôi có gửi cho tính làm vậy cho nó công việc làm chứ.
Hiểu chưa?
Làm hồi nửa đêm rồi. Mình đang ngủ rồi, tôi không để liệu nè. Tính thêm cái cụm đâu, nó đâu có muốn đâu.
Không cần đâu.
Nè, cái hình đơn nè. Nhưng mà nó mới dễ like trả cả chứ không dễ mấy hình kia. Hay sao?
Cái này thì đến nha, tôi dễ không mà bây giờ ông ghi cái nhận xét giùm tôi đi. Ghi cái display cái hình.
Cái gì vậy? Cái hình ngộ vậy?
Hình cũng thấy ngộ nữa.
Cái này là cái tại cái hình like, còn cái hình histogram là hình như này nè.
Này mình đang làm bon hay là stock?
Cái này là bond.
Return.
Nè, return nè.
Ủa return ta chọn cái này mà. Ta chọn cái kiểu này nè. Không phải cái hình đâu.
Cái này không?
Return là xài column đó. Không return không có nhấn, không đổi đây, ông đổi về cái đầu cái dữ liệu đầu tiên. Đúng rồi.
Thì đổi
Yes.
cái nào thôi.
not derivative as such. Whereas you
Còn dòng của mình ở phái sinh.
the price and from both, everyone agrees what the quality of the good is. And
Đúng
the
chăng
say how we specify
trên Edu Lao đó.
For instance, you also the juiciness, the color of the juice is also specified to make sure that the quality is
Thì mình lúc đầu có 4 cái à. Giờ có được hết.
Here, whenever you make a profit, you have a margin account, and you don't have that normally. Did you see about the margin account?
Nhưng mà cái này mình giải thích thì sao vậy? Mấy cái đóng mình nào giải thích tại ra mình có giải thích không?
Cái hình như là có, hình như là qua thời gian nó tăng hay sao đó. Giải thích không?
Sẽ cái hình hệ trả không ta? Có thời giá rồi.
Cái này là giá, cái kia là return. Bây giờ mới hỏi ông là cái chỉ số không là kiểu sao ông nhìn vô mà không biết nó là return hay là chỉ số giá.
So you didn't discuss a
Người
margin
biết phân biệt cái đó
accounting
không?
class then. So
Ý ông là ý tôi là cái đầu tiên cái dữ liệu đầu tiên á, mình lấy lúc nào mình cũng là cái lấy cái giá đóng cửa hết mà.
And how to
Rồi
work
mình
with
tính
the
dựa trên cái đó
margin
thì
account?
xong mình phân biệt nó là return, nó là price index.
You work it, yeah, okay, but that means that the students don't know what a margin account
Chia
is.
nó mới ra gì tên chứ.
Mình chia nó ra tên. Vậy cái câu hỏi là nói cái bản chất cái nature của câu chấm đầu tiên.
Then I'll go
Ý này là sao?
for some other
Price index hay là return index?
Giải thích trong cái cụ thể này luôn được chia hết. Nghĩa là nghĩa là cách tính nào.
Cái này nè, cái mấy giờ nè. Cái này mình in ra giấy không?
Không, bữa nay không. Đúng rồi, như tài liệu không? Tôi chen chồng.
Mà sao thời gian này thì về đúng không?
Không được.
Cái gì cơ? Cái gì cơ này bị sao rồi?
Xóa hết đi ông bà mẹ tôi thấy mẹ không tôi chỉnh.
Cái câu 3 là mình cần phải câu này là
Còn 3 là hôm qua tôi gửi ông đó.
câu 4 là mình cần phải kết hợp hai cái biểu đồ lại.
Có 4 hôm qua tôi làm sơ sơ rồi.
Nhưng mà mình phải kết hợp hai cái lại đúng
Không,
không?
không cần tính xác suất là xong. Còn đó tính xác suất là xong. Hôm qua tôi làm sơ sơ. Tôi làm 3 câu đầu. Tôi scan nó hết tôi gửi thôi. Xong tôi làm.
Làm sao?
để bà đi du lịch. Nhưng slide cái nào đó bữa nhắn cho Thư nhắn cho mọi người rồi. Tôi nói là con mới up slide rồi đó, Thư đúng rồi đó, Thư chắc đó.
Ý là được có độ tốt ra nào á. Phải làm gì vậy?
Đang làm nè.
Có giải thích không?
Đó, hình thì phải có giải thích. Thấy gì nên ghi đó.
Mà cái simulate gì đó.
Cái simulate đó là làm như cái bộ
Hẹn số bữa thì chạy
Nhưng mà
nhiều.
làm cái đừng mà cũng thấy đó.
ý này là vậy á.
Cái random đó là để xác định giá thì mà nó sản xuất thôi.
Đúng rồi, random đó cỡ ngàn giống hàng, cỡ ngàn giống hàng. Mình làm cho nên là cái gì?
Okay. Yeah, we definitely need to get back to work, but I got some questions about the trading game, so that's why I ran out of time. Before we go into the pricing of the futures, I just want to give you one example of what I mean with the margin account. Because it's not clear to me whether you all know what I am talking about. So I want to give you this example to show you the difference between a forward and a future. And so we assume, and here it's an old example. I didn't know, it's an old example and I didn't change it. But suppose that the current gold futures price is 1,250 per ounce. And that you have 100 ounces per contract. And suppose that the investor has a contract and he wants to buy 200 ounces at this price. What you see is that there will be an initial margin. So he will have to put $6,000 on his account. And there is a maintenance margin of 4,500, and this actually means that if he bears losses and the account of 6,000 drops below 4,500, he will have to make an extra deposit of 1,500 to make sure that he still has, or that he again has the initial margin. Okay. So the maintenance margin is usually 75% of the initial margin. That's typically, okay? So they ask you to put $6,000 on an account. In case there are losses, they can take the losses from the account. If the account drops below 4,500, they ask you to deposit extra, okay? And in this example, it's a very old example, so you start trading and you have settlement prices over different days. And so initially, so you start with a daily loss of 1,800. So he has two, so if you look at the data here, you have someone who has a contract for 200 ounces and the margin is for 100 ounces, yes? So he doesn't just have to deposit 6,000, but he has to deposit 12,000. Yes? And so his maintenance margin will not be 4,500, but it will be 9,000. It's because he's not just, he's not into 100 ounce, but he's into 200 ounce. So everything will be doubled, okay? So what I want to focus on now is this margin account. He starts with $12,000 in his account, but he's really having daily losses, few gains, but mainly losses. So you see that the margin account drops, and over here it drops below 9,000, and so then he will be asked to deposit to make sure that there is again $12,000 in his account. And then when he incurs further losses, again, it is below 9,000, he has to deposit again to make 12,000. Yes. So this is the margin account, and it is marking to market. every day there is a loss, it is taken from the account. Yes. So that's very different than with a forward. Because in a forward, it is possible that you have a loss during the lifetime of the contract, and then at the end, you have a positive payoff. That is possible, and you don't feel it. If that happens with a future, you end up paying throughout throughout just until the maturity. So it's very different. That's one of the big problems sometimes, is that a future is piling up losses, and you actually have to keep on depositing on the margin account. Okay. So that's something that you have to bear in mind. Now, I didn't add that in my current presentation, but as I said, on derivatives, if you want, I can talk for 30 hours, so that's not really a problem. Okay, so before we can actually answer this question, is there an arbitrage or not, we really need to go into the pricing of forwards and futures. And if we want to do that, we need to know what is short selling. Can someone explain to me what is short selling?
Short and you buy in a time very fast, short and buy again.
Yes, indeed. So suppose that so short selling is something what you do is you borrow actually an asset from someone's portfolio, you sell it, and of course you will buy it back later and put it back to its portfolio. Yes. What are your expectations usually when you short sell? You expect what? The price to go down, because it means that you sell now at a high price and you buy back later at a low price. Yeah, seems like a very good idea. So when you are short selling, of course, sometimes the one who actually lended me the asset doesn't know it's no longer in his portfolio. So suppose that I short sell a stock, and so that it's what's your
Khoa, my name is
Juan, yeah. That it's in his portfolio, and that I go short selling and I take the stock from his portfolio, and the stock is paying out a dividend. Who do you think the dividend will have to go to? Will it go to me? Can I keep the dividend? No, it should go back to him. Yeah, it should go back to Claes. So whenever you're short selling, or whenever the asset is taken from your portfolio, you shouldn't really notice. Yes. So you still get the dividends, because that actually belongs to you. So we have to bear that in mind. If we want to price a forward or a future, so we will have to do short selling. One of the concepts we need. The second thing we have to bear in mind is that a forward or a future on an investment asset is not the same as on a consumption asset. The big difference is that when it's on an investment asset, I don't mind if I have to short sell. But if it's on a consumption asset, if I would have to short, say, oil, and I actually need it, I actually need to consume it, I'm not really willing to sell it. Yes. So that's why there will be a difference between investment assets and consumption assets. For investment assets, we will find the price and we will get an equation. For consumption assets, it will be an inequality. We can find a bound, but we cannot find an exact match, you could say. We will look at a bit of notation, but we already did that. And so we will determine the forward price, and it's going to be easier for an investment asset than for a consumption asset. So I will mainly focus on the investment asset, but I will also show you, if you want, how to do it for consumption assets as well. So we need to know something about short selling. So you sell securities that you don't own. So your broker takes securities from another client's portfolio, you sell them, and you will buy them back later. The problem is that, so you have to make sure that the dividends are paid to the owner, and if you want to do this, then you typically have to pay a fee for this as well. But in a sense, it's not that big a problem. As I said, difference between investment assets and consumption assets. So for investment assets, we think about gold, silver. For consumption assets, assets that are held to use. So for instance, copper that you need to use, oil. These are assets that you typically want to use. And then we need some notation, and as I said, S0 represents the spot price today. Here we also use F0 for the future or the forward price today. We'll look at the time to maturity, the time until delivery as capital T, and the risk-free rate will also be very important, that is until the maturity. And what we do here is whenever we talk about derivatives, we will always use continuous compounding, always. So this is very important that we do that as well. When we do the pricing, for the moment we make a few assumptions and we assume that there are no transaction costs. Well, for individual investors this is not the case, but if you are a large player, it is, transaction costs are very low. We assume that there is one tax rate for every profit. We assume that there are equal borrowing and lending rates. So there you could say we may have to make an adjustment. And so what we assume as well is that in equilibrium, there is no arbitrage. Yeah? So in equilibrium, there is no free lunch, so we are in a no arbitrage situation. Under these assumptions, we will try to determine the price. We will try to price. We'll price forwards and futures. And typically, when I start pricing forwards and futures, I usually go shopping with one of my students. It's virtually, right? Just an example. And so what I typically do is say, well, and it holds here as well, if you look around Vietnam, and we always like, when we go on holiday, to take back something from the country to remember, to remind us of the nice time we had there. And one thing I really like are paintings. So, I really like paintings. And I was walking, we went to Ho Chi Minh City, and I saw several really beautiful paintings. But some of them were very expensive. So suppose that I take one of you to Ho Chi Minh City, and I ask you to buy the painting for me, and I will pay you back